It's a beautiful day in the neighborhood, a beautiful day in the neighborhood. Would you be mine? Could you be mine? It's a neighborly day in the beauty wood, a neighborly day for a beauty. Would you be mine? Could you be mine? I've always wanted to have a neighbor just like you. I've always wanted to live in a neighborhood with you, so let's make the most of this beautiful day. Since we're together, we might as well trade. Would you be mine? Could you be mine? Won't you be my trader? Good evening and welcome to ShadowTrader's Neighborhood. This is the ShadowTrader Video Weekly for Sunday, March 13th, 2016. Started off with the S&Ps here. You should see on the chart in front of you that you have a breach of the 61.8% retracement from high to low. Right, you can see I've marked it off here on the charts. Right, here's your high right here, and then your low is down here at the 1810. And we've breached the 61.8 in Friday's action, which was very, very bullish. So what does that mean? Well, when you go through the 61.8, basically, if first things first is if you're a bear, you should abandon all hope. And I'm going to get into that more in a moment. And secondly, you should expect that the market is probably going to move higher. So our next resistance point is right here in at the 2060 level. That's probably where we're headed. And if we don't stop there, then we're going to fill up this area up into the 2100s. Given that this has been such a large percentage move off of the lows, certainly the thought process is no, that can't happen. That would be insane. But it certainly can. I mean, we've moved well over 10% off the lows thus far, and we could certainly move much further. I do see a lot of congestion in the charts here, and that's probably going to stop the market around 2060. I think if you're not already long this thing, the next play would have to be short, I would say, up at the 2060 area. You have to assume that that first trend line is probably valid. I think the 2100 trend line here, which is really the more dominant one because it's the primary off of the all-time high, is probably stronger. But the thing is, you're not going to move in the market from 2022 to 2100. You're just not going to go straight up parabolic like that 80 handles, right? But you could easily float up to the 2060 or so, right? All right, so that being the case going forward, be aware of your overextensions from the 20 MA. Remember, basic rule of thumb is about 60 to 70 points. In this market, how this market's been acting, I mean, over the last couple of years, I've noticed that the stronger signals have really only come when it's been like 80 to 90 to 100 points, like overextended, right? And we got a pullback here this week that lasted all of one day. And then there was a big fake out on Thursday where you gapped up and you traveled 40 handles basically from high to low and then rallied back to a flat close. Those were just liquidation breaks. We'll look at that in a second in the profile. But at that point, we were somewhat overextended, right? If this is the peak here at the 2010, right, you can see that the 20 MA was here at 1920. So you were 90 points away at that peak. So just keep that in mind, that as this moves up, this is at 1954, and probably when it gets up into the 2050, 2060 area, if it happens relatively quickly, you'll be 90 points overextended again. So again, I'm just giving you an idea as to what you can possibly do with this market once you're there. But honestly, for now, it's bullish. Everything is just completely bullish. I was looking at all the majors on weeklies, and again, although it's parabolic straight up, there's still room to run to the upside. So again, the other thing also is that because you've not only breached the 61.8, but in Friday's action, you've actually breached the first downtrend line. So that's the thing. Can we go further? I think we probably can. We're probably moving up to this area. I'll be the first one to admit this rally is not one that I've participated in. I will be, again, full disclosure, I believe it caught me off guard because of the reason is that I didn't really understand why, and I still really don't, why a market would penetrate this double bottom low and then only go to here instead of here, right? As you know, my target was here. I was talking about this for quite a while, that I was looking at 1770. That's good. This is a third coast old ale, and it's really good. You know what my beef is with all this craft brewing is the fact that I was on top of this 26 years ago or so when I was in college, when Samuel Adams was brewed in like one place and you could only buy it in 3 states. And at that time it cost $6 for a 6-pack, which was exorbitant in 1980, whatever that was. And now the stuff is everywhere and everyone's on it. And this was actually given to me by somebody in our office here who is slightly overweight and wears Dockers. So, you know what I mean? It's just, it's not cool anymore. It's like, it's like craft beer is like running out of everybody's faucet now. I mean, everybody knows about it. Everybody's drinking. It's like, it's the new Budweiser, basically. That's what I'm saying. But anyway, I digress. But that's my beef with the whole craft beer revolution. Anyway, where was I? Okay, so trend line's been broken and probably moving up. Keep an eye. Oh, I apologize. Yeah, we're the area down here. This is what I was talking about. I was caught off guard with this by the double bottom here. I should have known better off of the hammer here that formed. But the thing is, like I was saying, is that it didn't make sense to me. Like, why did the market move to here, breach this double bottom, and then double bottom again and stop here instead of going to here, when the distance between these two is relatively minimal, and you had a very, very long-term trend line from the 2009 lows coming. Now it's at 1780. It was at like 1750 to 1760 before, right? So I don't know. That's the thing. That's what really surprised me about this market, and that's the number one reason why this move up here, I did not really believe in it. So anyway, that's where we're at with that. Okay, as I was saying before I got into that little bit of digression, I've looked at all the majors on weeklies, and everything kind of looks the same. The only one I would point out here, I do want to point out that the Dow hasn't yet hit this trend line, and it's quite a ways away here from the 17.6 area where I think it's going to reverse a bit. The Russell has gone from moving basically relative weakness to relative strength and back. Like if you notice, the Russell has been kind of seesawing between leading things to the upside and like leading things to the downside or lagging. In the bigger picture, it is still, because it was lagging for such a while, even though it's playing catch up now, pay attention, is that the Russell is basically going to run into some serious resistance right around 1147. All right, let's take a quick look at profile. There's not a whole lot I can share with you on this, but I will just point out a couple of things in that your focus here is that I had a long conversation with Jim Dalton, right? And again, I want to remind everybody that the intensive is on for April 4th. And it occurred to me recently that I didn't remind you guys at all, or even mention that you don't need to have taken intensive 1 to do intensive 2. They're not really connected. They're just separate times in the market. Basically what Jim does is he teaches live, trades live. Those of you that are on my email list, you got my email of a few days ago with the testimonials. All these people emailed in. I asked for testimonials. Everybody seemed to have loved it, said it's amazing. Jim trades. He talks about winners, talks about losers. He, shows you the mindset of why he was doing whatever. They're not connected. It's not like there's part 1 and part 2. Intensive 2 is just basically going to be him trading and calling the markets live for another 5 weeks from August 4th onward. It doesn't matter. It's the same exact thing. So if you're on the fence about signing up for it, I still highly recommend it. ShadowTrader.net/Dalton. That's where it's all at. Again, I can't recommend it enough. This is your last chance. This amazing person is not going to be teaching this again. He is retiring from teaching the profile, and it's just an amazing amount of knowledge, and it's certainly helped me immensely, as you know. That being said, I had those of you that have signed up through my website, you know that there's a bonus video of me and him, he and I should say. I don't know which would be more grammatically correct. Me and him and I, probably him and I. Him and I having a GoToMeeting discussion over the web. And one of the questions that came up in that discussion was the carry forward of the poor structure down in here. And he was of the same mindset that I was. I said, Jim, this thing is rallied on this horrible structure here and there, and also more importantly, this day in late February, which was just horrible structure. And I said, how long do we continue to carry this forward if the market never comes back? And he gave a very good answer. He said, look, you've got this consolidation here where basically the market could still come back down if it wanted to. Here it made an attempt, did nothing. If we start to break definitively above that level, out of balance, he was saying, to the upside, he said, then I'm probably looking to just let that go for now and assume that the market is going higher. That was really all I needed to hear. So that's the thing. The general rule is you carry forward poor structure and market profile references until they are repaired, right? But at the same time, there is a point where you just let it go, because you're not going to be sitting there holding on to like hope of like, well, this horrible structure below us needs to be repaired. The market should come back down and redo it, right? And I haven't been holding on to that. Believe me, I haven't been short into this move. I haven't really been anything into this move. Small stuff here and there, stick and move. But I haven't, as I said, this move really faked me out. I have not been in this move. So it's not like I'm sitting here hoping that this market comes down because I'm shorted and I'm screwed. That's not the case at all. But at the same time, I have been carrying forward this structure, and I will certainly admit to you, as I was saying earlier, that excuse me, I have been very doubtful of this rally, and this rally just won't stop. And one of the reasons I've been very doubtful of it is the points that I raised in the videos prior to this one, talking about A, the poor structure, B, the lack of participation of the Jumbotron stocks, where I felt that they were all lagging, the Facebook, Amazon, Netflix, Google, etc., things like that. There were a lot of things there. But at some point, right, once a market makes a technical signal like it has now, where it's crossed through a downtrend line, closed above a 61.8% Fibonacci retracement, right, you have to assume that the path of least resistance is to the upside. All right. That being said, you have breakaway value for the first time in a while today. So you have value breaking away from where the rest of the value was. Assume that's bullish. I also want to point out one thing that happened today in today's action is that notice that your pullback low was right to a prior high. That tends to be a relatively weak reference and shows you that people are chasing. I'm just saying, if you're going to carry forward any level next week, carry forward today's low. I'm recording this on Friday evening. Carry forward the 1995 50 or whatever this is, 1995 75, because it's no coincidence that it came within one tick of the prior RTH high and then turned around and started to rally. It's just that. That's short-term trade is right there, and basically the way you look at that is it's a weak reference point. It's a weak place to rally from. All right. Let's talk about pairs trading for a hot minute. As you know, I'm always hot on the trail of the old Shell CMS, and right now is no different. As it started to break down below the 50 cent level, roughly in the pair, and I'll show you a chart in a second. I like it there. I think my average right now is about a negative 55 cents. I think the pair is headed lower, and my MO is going to be actually to about double or triple or even quadruple this position, believe it or not. Even though it's decently sizable now, I want to quadruple it as the pair gets lower. This is one of the most high probability trades that I know, and I like it very, very much. And honestly, it has never been a losing trade for me ever, and that's saying something, because obviously over the course of a decade plus of trading, you've got lots of losers and winners, and there's lots of things that you can't really get a handle on, and some you can. And this is one that just seems to just work really well. You notice that from the chart, there's this continuous snapback to the mean, and I'll show you. This is the chart that Tom Cook uses. I made this up quite a while ago, and he's since then tweaked it. But basically, you have your correlation. Look at the correlation, how it's gone back up, and the correlation between the two pairs is very, very high. It's back to 98%. So if the pair is that correlated, that tells you that the odds are very strong that anytime it's going to get very, distended away from the mean, you're going to get a snapback like this. And my target usually on shorts has been back to the zero line right in here. That's usually what I look for. But again, if you look at the bands here, the channel of it, it is definitely on a downward trajectory. Over time, XCL is weakening in relation to CMS, and that tells me that it's a buy at lower and lower levels. So in this case, I started initiating around 40 cents, I believe, and I put some more on today in the 65-cent area. And that's basically it. I'm looking for more. If you're not in this yet, bravo, because you're going to have better trade location than me. But here's where I think the trade location is: negative 80 cents or better. And look for a pop back up to the midpoint of the range at the very least, minimum minus 40 cents. But I think the pair actually rallies up to about zero. But with the caveat that it has been trending lower for a little bit here. So you could go like this. But even this trend line down, and trend lines, they don't mean as much in pairs. You can kind of look at it just kind of sort of, but that would still take the pair back up to parity to the zero line. So that's what I'm looking for there in Shell CMS. All right, that's about it. That's really all I have for you this evening. This video has been going on for like 15 minutes now, and I'm actually out of beer, so that's why this video is kind of probably done. I was going to leave you with some notes on some Jumbotrons, but I'm going to be completely honest with you. I don't know what to say, because to me, they're still lagging, and yet they've obviously come off a bit off their lows. You can see Amazon here has stepped up its game a little bit. But in reality, what has really happened? I mean, not a lot, because here's the trend line break to the upside. And you're going to tell me that this is something for investors to get excited about? I just don't see it. I really, really don't see it. So a weak advance here, and I'm just using Amazon as a proxy. You can really put up any of the Jumbotrons. They kind of look the same. A weak advance here as a proxy, to me, would possibly set up a trend line short, basically. You're just going to have to go with the trend line. And then it's going to be a breakdown back below. I think part of me is just is continuing to not believe this rally, because there's some point eventually where you don't always go to new highs. Basically, that's my thought process. Is you have a market that, for many reasons that I've laid out before, has been very, very driven by crude oil. The majority, if not all, of the move that we've had just far has been driven by strength in crude oil. You've had Jumbotrons lagging. You've had rotation of leadership into some sectors that to me are less than desirable, like that to me feel relatively defensive. So that's just my take on it. Again, I have to stress, I'm not bearish, have not been bearish. I had a bearish position coming down into that 1810 area. I certainly was looking for lower. I had to reverse, but that's just my thought process here coming into this area here where we are now, to see if the market does make the run towards the highs or not. My thinking at first is probably a relatively long pause at some point at the declining trend lines before it makes it up to that area, right? You see this is the S&P here, so we're going to be looking at probably a stopping point somewhere in here at the 2050 to 2060 area, and that will probably be a good bet to get active in the markets. Again, more than likely to short side. I would be looking for at least a 50% retracement of this move. Don't forget, you've come at least 10% off of the lows, so you're going to be boxing off this area here, and you're going to be looking at something like this. Depending on how those candles close on the weekly, that will then tell you if you're going to go back and retest this area. And this is just kind of bigger picture thinking, but if that does happen, that I want you guys to keep very much in mind, very, very much in mind, that this is not just a double bottom, this is a triple bottom, because you were here before. And if that happens, then this trend line here is meaningless, and you're going to get the market going much, much lower. But again, this is just kind of thinking out loud for later on. For now, very, very bullish, remain bullish. Market's probably going a bit higher. S&P's at 2022, probably going up to about the 2050 area. All right? Have a wonderful day in the neighborhood. On behalf of myself and the entire ShadowTrader team here in beautiful Philadelphia, Pennsylvania, I wish you good trading and good night.